Welcome to Petros Family Wealth. Today we're going to talk about structured products and how they work. Let's go ahead and dive in. So today we're going to talk about structured products. We're going to touch on the growth of the use of structured products in our industry. We're also going to talk about how they work. And we're going to show some hypotheticals or examples, some concept pieces to help understand how some of these might be incorporated into a portfolio. And then we're also going to touch on the two biggest risks associated with structured products. Just as a reminder, this is not a specific recommendation for you and your family, nor are they past recommendations for other families that we serve. This is purely meant to be educational, to arm you, educate you, help you become a better investor, more informed investor for you and your family. So with that in mind, I wanted to start off with structured products and the growth of this asset class in our industry. So I'm showing you here a listing of new issuance or new structured products by calendar year over the last several years. And as you can see, pretty substantial growth rate. And this was as of the end of 2022. The data coming out of 2023 hasn't come out yet. But the use of structured products is growing substantially here in the United States. This was and is incorporated more so in Europe and Canada, but they've been around since the early 2000s. And part of the growth in our industry here is that they have become a little less complex, although they are still and can be complex. And the other benefits, these generally do best when interest rates are high and when volatility is high, which we can touch on when we talk a little bit about how they work. I also want to touch on some of the biggest issuers out there over the last several years. You can see on here on this list, you got Barclays, Morgan Stanley, Goldman, JP Morgan, UBS, Bank of America. Generally, they're from larger institutions. And when we get through some of the bigger risks out there, there's generally a reason why you might want to diversify your issuers in a structured product portfolio. But as far as how a structured product works, just at a high level first, before I show you some examples and graphics here, a structured product, in essence, is an underlying bond, meaning that in a traditional bond, let's say I lend $1,000 to a bank for 5 years, they might pay me 5% interest per year, and then at the end of that 5 years, they give me my principal back. So if I lend them $1,000, over the course of that 5 years, they pay me $250 in cash, and then my $1,000 back. A structured product, we lend that same $1,000 to a bank, and instead of them paying us $250 over the course of time, what we ask them to do is buy up $200 worth of options, and we can format them in an income-oriented structured product or a growth-oriented structured product. And we have a couple different videos out there explaining the different types and some examples. But they use that $200 to find some of the outcomes that we might want to see in a portfolio. And so here I have a graphic of the building blocks of a issuer protected market linked security or structured product. In this example, we lend $1,000 and the issuer uses $800 of that for their general purposes, and they owe us $1,000 at the end of that maturity. But our goal is to have an underlying investment and options package that grows over time, more so maybe or more consistently than either a stock or a bond in some cases. As far as building out some of the building blocks of a structured product, of your $1,000, $800 goes towards that zero coupon bond, and they might buy a call option on the underlying investment that we choose. That costs 27 of the $1,000 we gave them. They might cap or a hedge that helps pay for some of those call options, and that results in an example like this where we have a 5-year structured product based on the S&P 500. Our upside is maybe 100% of the S&P 500, but this we have a capped return of 75%. And our downside is 0 so long as the issuer pays their debts. And so in this example, if we were to put $1,000 in 5 years from now, let's say the S&P 500 is up 50% over that time, well then the client would get a 50% return. If the market goes substantially higher, let's say it's 100% gain over that 5 years, well we're topped out at a 75% return. However, on the downside, let's say the S&P 500 is down 20-30% 5 years from now. So long as the issuer that we choose continues to pay their general obligations, then the client would receive all the principal back, didn't lose anything. And so this might be a good fit as an example for somebody that knows or feels that they need to invest in the stock market, but want to have a high level of protection compared to buying just a pure stock index, and so that they can get potentially some of those upside, but reduce some of their downside factors. So those are some of the mechanics as far as how they work, and both in concept and practice there. But we also want to cover what are the two biggest downsides of structured products. And number one is what's called issuer risk or credit risk. Because we're lending money to a bank, similar to a traditional bond, if that bank fails or goes through bankruptcy, we'll likely lose all of our funds, even if the underlier is positive or down not that much. And so that's by far the biggest risks of these structured products. And so we can try to mitigate that by, one, changing up the issuer and diversifying our issuers, even if it has similar investment characteristics. May want to diversify our issuers. And then also, similar to a bond ladder incorporating in a fixed income portfolio, we might want to ladder these investments and build them out over time. And so that way it's diversified both across issuer and across time. The second biggest risk is what's called statement risk. And what this means is that even in that example where it's fully principal protected based on the faith and credit of the issuer, even if the underlying investment's positive, let's say 10%, on your statement, the structured product might show up in year 2 or year 3, maybe even as a negative return, because it's not fully reflecting what's happening underneath the hood. So the intrinsic value of receiving your principal back or getting that gain from the underlying investment is different than the actual market value that we might have to sell this at. So these are designed to be purchased and held to maturity. You can sell them, but generally you're going to have a discount to the intrinsic value. You don't get the full benefit of the hedges if you try to decide you need to sell these before their maturities. So those are the two biggest risks: credit risk or issuer risk, and then the second is statement risk, showing that the market value and the intrinsic value generally are not the same all the way up until the actual maturity. So I hope you found this helpful, and if you did, please go ahead and like, subscribe, and hit that notification button. Thanks so much.